everyone. On behalf of the Morningstar team, I'd like to welcome and thank you for attending today's forum. A very special welcome to all those new firms that have recently started to strategically partner with us as we provide our three pillars of how we serve advisors, being practice optimization, behavioral coaching, and investments. I know the team are absolutely delighted that you can be here. We're super excited about this event, and we're really looking forward to engaging with you. In terms of just some housekeeping before we start, there will be a Q&A section, and there is an ability to do that through Zoom. Please send your questions. We're really looking forward to getting them and engaging with the speakers. From a polling perspective, we are intending to do polling through the sessions. Please do provide your perspectives. It is important to us, and I think it will really be super valuable for the discussions with the respective speakers. So what I'm going to do now is really frame up today's session and what you can expect to hear from the agenda. As I said earlier, the team are particularly excited about this new forum that we're launching today. As this is our first significant forum that is purely focused on practice optimization, best practices for advisors, we thought it was important to provide a background to our focus in this area and frame up what you're going to be hearing today and more into the future. Firstly, the event itself. Planning for this forum has been in place really since the beginning of the year. Our intention was for this to be face-to-face. In the challenging times we've had this year with COVID-19, it's obviously been impossible for us to get together face-to-face as a community. So we pivoted and to see how we can provide this forum on a digital virtual basis for you. Conscious of Zoom fatigue and applying our learnings from this year in this respect, we've split the forum between sessions in a format that keeps it engaging and valuable for you. There'll be 2 sessions today and another 2 on Tuesday. As you know from previous forums, we have asked for feedback, we've listened, and we've been developing initiatives based on what you said was of super importance to you. As a result, we're building more and more in-person and digital-based forums and webinars consistent with your feedback. The first key piece of feedback received was that you want to hear more from your fellow advisory peers in the community, so you can leverage off the individual and collective best practices shared between you. Increased opportunities also to engage with our global thought leaders in the business, such as Daniel Needham, Ryan Murphy, and a number of others. And finally, an opportunity to also engage and hear from different industry professionals, bringing new perspectives to the challenges and opportunities that you face each day as advice practitioners and advice business owners. So how we continue to develop to support you? As you would know, there are 3 pillars to a trusted business partnership, which really drives everything we do as a firm. And that is investment solutions, behavioral coaching, and practice optimizations. We see ourselves as joint fiduciaries for you. And at the center of these 3 pillars is your clients' goals, and they are key for everything that we do. While you've seen a significant amount of support and resources around investment solutions and behavioral coaching, particularly over the last couple of years, there's a 3rd pillar of practice optimization that is the purpose of today's forum. In the introduction for the next week's 2 sessions, I will provide a short overview of our why and how we committed to building more and more support on this practice optimization pillar. More next week. Of super importance though, is that neither one of these pillars is a standalone pillar or foundation of how we serve you. They're all interconnected and integrated into our service offering, which I think is a good segue into our first session today with Daniel Needham, which is really focused on the investment solution component. As you know, Daniel is the President and Global Chief Investment Officer of Morningstar, and someone you all know well. I know Daniel would love to be here in Australia at this time of the year, getting out of Chicago, but unfortunately, due to the times, he can't be here, and I know that he's really excited to be going through his perspective in 2020, looking beyond in 2021, and really, and I think the title of his presentation really sums up the connectedness with practice optimization. Staying on course when it feels like everything is changing. Over to you, Daniel.
Thanks, James. Thanks for the kind intro, and thanks to everybody for joining us today. hopefully you can see my presentation, and we'll be good to go. So, you know, there are lots of things that I could have talked about today and covered, but you know, I think it's you know, it's important in this environment to sort of step back and recognize, you know, why we invest and what the purpose of our strategies are. And I think it's been certainly a challenging environment for investors to stay the course, but also, frankly, for investors that are for asset managers and financial advisors that are pursuing a valuation-driven approach. It's been a challenging environment, certainly in the last 12 to 18 months. And so today I wanted to spend a bit of time on just sort of reinforcing some of the things that that we think are important, and then I look forward to questions as well, as we go, and hearing them from James at the end. But first, you know, I thought it would be good just to sort of recap on the Morningstar Real Return Fund, which, you know, is our core sort of, let's call it sort of flagship strategy, and it's also reflected in our growth managed account strategy. But this shows you the performance of the strategy from effectively 2010 to 2020. So effectively a 10-year period where we've been applying a valuation-driven approach to asset allocation and portfolio construction. And this highlights the performance relative to our CPI objective. And so over the long term, we've achieved the objective, or we've exceeded the objective, but it certainly hasn't been a straight line. And this environment right now that we're in really does bring us back to a period that we faced early on in the last decade, in sort of 2010, 2011. And so I wanted to sort of use those examples. I was effectively portfolio manager of the strategy back then, and thought I'd use some of those examples to sort of explain how maybe the period we're in now has a parallel to the period that we faced early on. And so back in 2010, we established a number of really attractive investment positions. And one of the main reasons that we were experiencing this sort of period of underperformance here was that we were getting established in some really attractive investment opportunities. And so we were underweight Australian shares, and we were very much overweight and built very large positions in Japan, as well as unhedged equity. So we effectively removed the hedge on our international equity portfolio. So the Australian dollar, you know, hit 110, and at that stage we'd removed the hedges. And you can see, so firstly Japan here, which was we established after Fukushima, and before sort of Abe introduced the 3 arrows, and we saw a significant period of outperformance, but it was very painful establishing those positions, as well as our unhedged position. You know, building our unhedged position when the Australian dollar was continuing to rally was very painful. But ultimately, as you can see with the performance, the green line of unhedged equities, we saw unhedged shares really do well. At the same time, in 2010, we established a position in Australian REITs. So I would say in 2010, Australian REITs were pretty much one of the most unpopular assets in the Australian equity market. I mean, effectively, few investors were so burned by 2008 and 2009. And so we actually built a position, and we had more in effectively more in Australian REITs than we had in Australian equities. We built a relatively large position, and then we saw Australian REITs do really well. And so, you know, we're reminded of that environment now where we've been building some investment positions that we would say are unpopular, but we think are really positioning us to outperform. And the reason why a decade ago is relevant for now is because we're effectively applying the same investment approach. We haven't changed the way we manage money. This shows you the relatively simple visualization where if the orange line is value and the red line or the maroon line is price moves up and down or around value. When we can buy investments when the price is below fair value, then we have a greater potential for returns and a lower potential for losses. And we've been applying that approach for over the last decade or more. And what we're seeing right now is the similar opportunities. And so we believe pretty strongly that this approach will prove out over time, and that the challenges that we felt in the short term, we think will be more than made up for in medium to long-term returns. And so we'll continue to be disciplined and apply that approach, and we'll continue to look for opportunities. And with that said, we think we are in a really unique period, and we think there's some really attractive opportunities. And I'm going to touch on one now, which is more of a thematic opportunity that we see, and then then I'll go into some detail on some specific investment opportunities. But right now, value strategies, so strategies that seek to buy companies on low price earnings and price to book multiples and high dividend yields and high free cash flow yields, have actually meaningfully underperformed growth strategies. And so this orange line shows the excess return relative to the MSCI World, so global growth versus world, and the blue line shows value. And so what we can see is that value has underperformed the market and underperformed growth significantly. It's actually been one of the worst periods for value really since this value index has been tracked. And growth has done incredibly well, and much better than how it performed in 2000 with the tech bubble. And what we find is that when value performs poorly, it's normally around a period where there's a recession or concerns about a recession. And we think it's if you think back to 2018, markets started to sort of prepare a bit for a recession, and so we started to see the growth-oriented stocks start to do better. And so if we go back and look at history, we can see I've got the arrows here, sort of the starts of economic recovery. Each period where there's been the beginning of an economic recovery, we've seen the blue line overtake the orange line. And this has happened pretty much in every recovery. And so what we're seeing right now is one of the deepest but shortest economic contractions. And we think that value is a strategy that should do well. So if we look at our strategies, we've definitely been more sort of value oriented than we really have been pretty much since we started managing the strategies or applying this investment approach. And to give you an idea, this shows you the performance of value versus growth on average. So this 4.05 is how much value's outperformed growth over the long term from 1960 to 2009. And then this bar here shows how it's performed after a recession. And so after a recession, the year after a recession, value has outperformed growth by about 2.5 times what it does normally on average. And even after 3 years, value outperforms growth by more than 2 times. And we think we're in a similar situation. So we feel like value relative to growth is really pretty much the most attractive we've ever seen it, even more attractive than the 99, 2000. And so we like to think about the portfolio's position. If we look at all of our positions, all of our equity positions, say within our growth real return fund, and we look at the factor exposures of that portfolio, we can see that this line here shows the value factor using effectively a holdings-based factor model. And we can see that our value exposure is pretty much the highest it's ever been. And we think about this as a coiled spring in the portfolio. So with the economy recovering, we think value is well positioned as a style to do much better than it has historically. And so our portfolios have definitely shifted to value. And so we feel really good about how the portfolios are positioned given this really popular period for growth and very unpopular period for value. But I wanted to sort of now shift to some specific opportunities, and I really like this way. I think this line really describes our investment approach well. We like to fish where the fishermen aren't. And I would say that most investors, or the sort of consensus approach to investing, is to fish where the fishermen are, and it gets pretty crowded. And so we like to find places where a lot of investors aren't, and we particularly like unpopular parts of the market. So in this environment, I'm going to run through 2 examples, which you've probably heard us talk about, but I'm going to dive a little deeper into these 2 examples and also add a stock story just to bring it to life. But firstly is really energy. So we've talked a bit about energy, but right now we're seeing energy, the effectively listed energy stocks, underperform the market by really a record level. And so what this shows is on the right here, the top chart, the blue line is MSCI World, and then the beige is energy, and then the red line shows the spread between the two. And we've really seen one of the worst periods of performance for energy, and this has really presented an interesting investment opportunity for long-term investors. And we think this period of underperformance is a bit different to the last couple. So the 2 big periods was really the oil challenges of 1980 after effectively the commodity investment boom, and then 2016, which we all probably remember, which was, again, that was on the back of the shale investment boom. This time, we think this is mainly cyclical. The supply side, which I'll touch on, has improved, but the main driver of the energy underperformance has been a combination of a relatively rare, but we think unlikely to be repeated spat between Russia and Saudi Arabia, combined with a huge reduction in demand for oil, given the economic slowdown. And what that has meant is that the energy sector has become so unpopular that a single company, Apple, is actually worth more than the whole of the global energy index, which is, a good measure of just how unpopular energy companies are right now, and why we're effectively so bullish on the opportunity. Probably the most important element of investing in commodity companies is really the supply side. And what you really want to see is you want to see supply contracting or supply growing at a slower pace than demand. And so the blue bars here show the inventory, the implied inventory build from the difference between supply and demand. And what we've seen is that over time, we've seen the inventory draw, which is these 3 bars here. But then effectively, as COVID has hit, the inventory build has gone up, and that's really been one of the drivers of pushing the oil price down. Now, what you can see is that the yellow line is effectively running ahead of the maroon line here, and that means that really oil is being drawn down and supply isn't keeping up with demand. We think we're in a position where we may see extreme shortages in the oil market, and so the supply side's pretty slow moving. And so we've seen the number of rigs get cut. We've seen the amount of capex of oil companies and oil services businesses get cut significantly. And so we're pretty bullish about the opportunity that this supply shortage is going to cause. Now, right now, no one's worried about this because everybody's worried about the transition away from fossil fuels, which, we think over the long term, we're likely to see a transition, especially in the OECD, away from oil and fossil fuels, but it's going to be a lot slower than what people are expecting. And in some cases, we're likely to see continued growth, material growth in the consumption of fossil fuels, especially in the developing world or the non-OECD world. So what we can see on the right is that, over time, places like Brazil, places like India, places like China are going, even though electric vehicles are increasing, they're going to continue to rely heavily on combustion engines. And whilst the OECD will go sideways, we're also seeing the increased use of natural gas. So natural gas is replacing coal for energy. And so a lot of the way that developed economies are going to meet some of their carbon emission targets is to use effectively to use gas instead of coal. So overall, we think that, if you think about how things get moved around the world, you've got ships. So ships use a huge amount of diesel, and there really is no substitute right now. If you want to move containers around the world, then you need to use ships, you need to use oil. If you want to fly a plane, jet fuel is required, you're going to need oil. Most vehicles are going to be combustion for probably the majority of vehicles, trucks will be combustion. So we think that there's been too much of an overreaction. Now, we definitely think there'll be a movement away from fossil fuel, but oil demand is likely to continue to be pretty robust for some time to come. Now, to give you an example of one of the stocks that we like, so BP is one that is a position in our portfolios, and it's a pretty good sort of example of the opportunity that we're seeing. So it's an integrated oil company, which means effectively they do upstream, so they'll effectively do exploration. They'll also do refining, and then they'll retail or sell the oil through different products like petroleum products. And BP is one of the better run integrated oil businesses. It's also very low cost, so has a break-even oil price of about $20, and you can see the structural change in that chart. So this chart shows the break-even price required to cover capex and dividends for BP and effectively the EU oil majors. And you can just see the fact that line is declining just shows how much more efficient these companies have become at managing their capital. And so they're just their operating costs are lower. Their ability to profit from relatively low oil prices is much higher. And so if we look at how they're positioned now to sort of, a decade ago, we think they're completely completely different businesses. And many of these businesses like BP are also positioning themselves to take advantage of increasing clean energy, so renewables. So we feel like the market is being overly harsh. And so when we look at the implied growth rate for BP right now, it's effectively assuming there's going to be zero growth in perpetuity, so that it's never going to grow again, which we think is overly conservative. And so we have equity analysts at Morningstar that cover stocks, and the bottom right-hand table shows you their valuation for BP at the individual stock level. So their fair value is effectively at 5.4 pounds, whereas the price back at the end of October was sitting more around £2. And so there's huge upside in these stocks. And when we look across pretty much most of the developed energy companies, integrated companies, as well as pure play oil services businesses, we just see valuations that just don't make sense. And so that's why you'll see oil and oil-related businesses representing a pretty large part of our portfolio. And we're pretty optimistic about the outlook at these prices. The next sort of opportunity I wanted to touch on, which is, there's a little bit of overlap, but really is the UK equity market. So if we take a similar lens and we look at the performance of UK equities in the light green color versus global equities in the light blue. Sorry, it's a bit hard to see that, but the red line represents the performance of UK equities versus world equities. And what we've seen is that it's been a period of significant underperformance. So this shows you on a rolling 7-year basis that UK equities have really underperformed by the most since the 72-74 stock market crash, effectively when Margaret Thatcher took over and completely restructured the UK economy. And so there's a number of challenges for the UK market faces. So obviously Brexit is the one that everybody knows about and everybody asks questions about. And so that is definitely being reflected in the price, we think, as well as COVID-related challenges. So on balance, the UK stock market is more exposed to cyclical sectors like energy companies. BP, for example, is a UK company, as well as a relatively large weight to banks and cyclical consumer businesses. And so this is really interesting for us. We see UK equities, we see them really lag, and we're contrarians, and so we ask the question, well, is the market right, or is this an investment opportunity? And so when we took a closer look at the UK market, what you find is that actually, even though the UK stock market has UK on it, the UK companies look very different to the UK economy. And so this gives you a snapshot of the revenue exposure of the large cap UK stock market by country. And actually the largest revenue driver of the UK stock market is actually the US economy. So if you break revenue down to its source, and then China is number 3. And so what we find is that the UK stock market is actually less than 70% less than 20%, less than 30% UK revenue, and over 70% of effectively non-UK revenue. So one has to be careful when you're thinking about the UK stock market and recognizing it's actually a global stock market, which we think makes it a lot more interesting, because then we can say, well, how important is Brexit to, let's say, 75% of the revenue that's sitting in these companies? And so once you take a closer look, you realize, well, maybe this doesn't quite make sense. And if we look at the valuation for UK stock market, so this green line shows you the normalized PE ratio relative to Europe, and then also relative to the US. And back before 2009, the UK stock market, the European stock market, and the US stock market, they traded on relatively similar PE ratios. Europe and the UK generally traded pretty close. But what we've seen is that the UK market has diverged from the European market and the US market to the point now where we think that discount does not make sense. We think that the UK market is trading on valuation multiples that are not justified by the fundamentals. And we think a lot of that's got to do with the fact that people are pretty negative on cyclical businesses, and they're really concerned about Brexit. And when we look through Brexit and we look at the potential impact on the cash flows of UK companies, we just can't get to the kind of discount levels that the market is applying to this market. And so taking a bit of a look at the profitability for UK, we can see that this shows you the return on equity for the UK stock market, and definitely profitability is down. But heading into the COVID panic, we'd seen a big improvement in profitability from 2016. And a lot of that has to do with the fact that the UK market had a relatively large energy exposure and was hit early on. Now, we've seen this drop in profitability. Now, clearly that's been influenced by COVID-19, and it's affected the banks, it's affected the energy companies, it's affected consumer cyclical businesses. It's affected a lot of those businesses that are exposed to the economic cycle. Now, when we look at the UK market in aggregate, we see a stock market that's made up of relatively high quality businesses that have got pretty diversified revenue from around the world, that have got financial leverage that's been coming down. A lot of the banks have been really improving their balance sheets, and I'll touch on that in a little bit. And so when we look on a forward-looking basis, we think we've got a market that has got improving prospective profitability from the economic recovery at a multiple that is much, much lower than history, and also relative to similar markets like the UK or the US. And so we're relatively positive on that. And I think Lloyds Bank is really a good example of this. And so Lloyds Bank is a UK bank. It's actually the largest retail bank in the UK. It was really spread quite wide prior to the global financial crisis. They had a lot of businesses around the world and in the UK. The new CEO came in, he effectively exited a lot of those businesses. He shifted Lloyds to being really a domestic bank. 90% of their revenue comes from the UK retail banking industry. It's a low risk retail bank, and it's very well run. And so it's got a very stable domestic deposit base, which means that they don't have to worry about institutional funding. They've got retail investors are funding a lot of their balance sheet. They've got a huge amount of capital, so they've got excess capital of over 300 basis points. So they've got excess capital that's growing as they're not paying dividends in this environment. And it's run from a very it's run on a very cost-effective way. So these charts that we've got here show the total costs in the first half of 2019 versus the first half of 2020, and they've been able to reduce their costs by 4%. And if we look at their costs over time from 2010, coming out of the global financial crisis, they're actually much, much lower in 2020. So this has really been a great story of a business that's gotten has narrowed its focus to what their core business is. They've been able to shift away from funding themselves in capital markets towards a retail depositor base, and they've been able to significantly improve the efficiency of their business. And I expect that to continue. So we see a business that's actually well positioned, that's got an ROE that has a lot of upside. The UK government owned a portion of this bank. They've exited that. You've got a business that's ready to return capital to shareholders. And if we look at the valuation, so this again is from one of our bottom-up equity analysts. And so this shows the price of Lloyds as at the end of October, and then it shows their valuation. So the fair value they have is about 62 pounds versus 28 pounds at the current level. And there's just huge upside. So their bull case has it at 82. So we think the Lloyds from this level, we would not be surprised if the recovery, turns out to be more optimistic than people are expecting, that this bank could triple in price. And we think that the market is pricing in some pretty negative outcomes. And so overall, when we look at the opportunity set, it does remind us a lot of 2010 to 2012, where we saw some actually relatively good assets that were very much out of favor, where we could see a positive catalyst to cash flows that the markets were just not recognizing. And certainly we think energy and a lot of those high quality energy businesses, integrated businesses, and we think UK equities, especially within the UK banking sector, we think there's some really attractive opportunities. And this is just a sample, I guess, of some of the opportunities that we're seeing in the markets. And but I would say also, this hasn't been smooth sailing for us. There's been opportunities that we've missed, and I just touch on those very briefly. But it really centers around the UK equity market, but more specifically, it relates to US equity markets. More specifically, it relates to US technology or technology-enabled businesses. And so, we build our models based off history and what we think is reasonable to expect over the future. And the US has been a really unique market in the sense that we've seen good businesses go from being good to great to outstanding, and profitability has just been much stronger than we expected. And so what we've seen is that we've seen businesses have generated higher return on invested capital in those markets, especially within technology, as well as within technology-enabled businesses like Amazon, Google, Facebook. And what we've seen is that they've been able to remove competition through acquisitions. They've achieved scale quickly. They've got relatively low capital requirements, and they've disrupted traditional business models. And there's just no doubt we did not, a decade ago, we did not see the success of Facebook, Amazon, and Google. And so when we look back and we say, well, we definitely made a mistake, and we underappreciated their profitability, and also the fact that interest rates have come down. We've seen long duration cash flows like growth businesses have been really highly valued by the market. And so when we look back, we definitely underappreciated the ability for these businesses to expand their profitability at phenomenal rates. Now, the most important question for us is, so we missed an opportunity, and so we could call that an error of omission. But the question for us is, what should we do now? We've done our research, we've dug in, we feel like we understand these businesses better. Do we then reverse our course and buy these businesses now? And our main concern with that is, well, we may have made a mistake by missing them, but do we want to make an error of commission by buying them now? And so we're definitely concerned, even when we adjust for this and assume that this profitability can continue at a reasonable rate, we struggle to see the current valuations justified. And so we've definitely made a mistake in being too conservative historically in valuing them. But even after adjusting for that, we have our reservations now. So this next chart shows you the share of Facebook, Amazon, Microsoft, Apple, and Google as a portion of the S&P 500, and it's well over 20%. And this is really just extraordinary. So the market has recognized, we think, and then some, this improvement in profitability. And what we actually think is that the market is pricing in that what we've seen in the last 10 years will happen again. And a way to work that out is to say, well, if we look at the current price and we say, okay, let's look at how the business is currently priced at by the market, what the current cash flows are, and then let's try to work out what's implied by the market to happen over the next 10 years. If we assume that they're going to be able to earn very high rates of return from years 20 to years, from year 10 to year 30. And so we work out what we call an implied growth rate. And this shows the implied growth rate for Google, Amazon, Microsoft, Apple, Facebook from current levels. So we ran this back in May, and so the numbers they're actually not that different if we reran them now. But effectively, the average growth rate is about 18% or nearly 20%. And just to give you an idea, historically, the median company from 1950 to 2015 in the US has grown at about 5 to 6%. And so now we might say, well, it's okay for really good companies to grow at high rates. But the challenge is when you've got businesses that have market caps, over $1 trillion and hundreds of billions of dollars of revenue, it's really hard for them to continue to grow at 20%. Just the law of large numbers come in. And so the question for us is, what do we do? And when we look at the valuations, we think now's not the time to add. We recognize we underappreciated the valuation of these businesses, and we're improving our valuation models. And we're really asking ourselves, how do we make sure that we don't miss these opportunities again? But we think when we look at the prices right now, what's implied, we just really struggle to justify. And so we think these markets are still overpriced, but they're just not as overpriced as we thought they were. Michael Mauboussin has a really great line. He says the goal when you're betting on horses is not to pick the winner, but to rather pick the horse that has odds that are mispriced relative to the likelihood of winning. And that's how we have to think about markets. It's not about investing in the best company. It's about investing in the company that's priced the best relative to what you expect over the next 10 years. And so when we look at what's implied by Apple, for example, they need to find another $327.7 billion of growth in the next decade to justify their valuation from this level. Now, they're a great business and they're likely to be a cash cow, but it's very unlikely they're going to be able to to effectively create another iPhone. It's possible, but the question is, do you believe those odds? And we're skeptical, and we think the fact that they need to grow at over six times the entire market cap of BP says to us that we're not ready to take that. But where we're positioned right now is, should these companies sell off, should the shine come off them as investors shift from growth to value, we think we're going to be in a good opportunity to take advantage of better pricing on those businesses and learn from our prior errors in evaluating them. And so, look, overall, we still feel good about our approach to investing, and we think we'll continue to see high conviction opportunities. And this is our kind of tail of the tape, for the last 10 years. Every year with our approach, we tend to see, 2 or 3 opportunities pop up, and over time we're able to build those up, and then we reduce them. We tend to sort of, hold investments for, a 3 to 5 year period will be when we're kind of, when we're building them up and then starting to reduce them. Although we take our time, and we think our approach is going to continue to help us identify opportunities, and we think right now is one of the most attractive periods that we've seen in a long time. And also, I can answer questions in a minute as it relates to the economic outlook and things like that, because I think that is certainly relevant. We think we're entering an economic recovery, and we think the market is pricing a continuation of the last 12 to 18 months from a sort of a social distancing and a lockdown perspective. And so, we're going to continue to be contrarians and look for opportunities. And so, as we've been moving towards away from sort of, growth and towards value, as we've been increasing the value exposure of our portfolio, we've actually seen investors continue to invest more and more in these growth businesses. And we think, the challenge with investing, obviously we're going to make investment mistakes. We don't want to make them, but we're going to make them. We just know that's unavoidable. We just obviously try to get more decisions right than we get wrong. But we always think that the biggest challenge for investors is themselves. And I love this quote from Julius Caesar by William Shakespeare, where he said, "The fault, dear Brutus, is not in our stars, but in ourselves, that we are underlings." And what that really is interpreted as is we can be our own worst enemies. And our view is that the opportunities that are presented to us are behavioral opportunities. They present themselves because initially there's truth in the concern, but they get investors extrapolate either on the positive or the negative. And that's really where we see the opportunities. And it's often in extreme environments or extreme markets that rationality pays off. That means being willing to take a long-term view, looking at the facts, trying to weigh them as best you can, and then being disciplined in how you execute. What we find is that actually in extreme markets, instead of being rational, investors tend to have a relatively short frame of reference. They will take relatively simple views about where the opportunities are. So right now, businesses that did well during the lockdown have seen their share prices increase, and investors that continue to bet on that simple theme. And we think when you step back and reflect, you could say, well, if there's an economic recovery, that could actually turn out to be a really bad investment. And so we try to apply that second level thinking. And really the core to our investment approach is being willing to be different when investment opportunities are attractive. And we think the best opportunities often come in times of great uncertainty. And in 2020, what we saw in March was an opportunity to become bullish when everyone else was becoming bearish. And they've been becoming bearish in parts of the market that are very cyclical. And so what you'll see with our strategies is that we're going to continue to own investments that are probably going to be more volatile and bump around a little more because we think investors are mispricing the impact of an economic expansion and a recovery. And we like to fish where the fishermen aren't. And that's really one of the main reasons why we're positioned the way we are. So hopefully that was of use. I'm happy to answer any questions. And, look, we're going to continue to be disciplined and search for opportunities wherever they may lay.
Thank you, Daniel. That was great, and a great presentation, really describing our contrarian valuation approach and how we apply it. A number of questions that have come through. There's a consistent one that really resonates with everyone sort of setting through, and that is, generally, when are we looking to add cash to market, given that things look more promising in the global sense? In other words, is now the time to start deploying more cash?
Yeah, it's a good question. I think we definitely reduced our cash weights quite a lot in 2020, especially around March, and we've been bringing our cash weights down. So we've been increasing some of our cash, but it's really been through reducing our exposure to these large cap US equity markets. So we've been reducing our exposure to the S&P 500 and increasing our exposure. So we still have a decent amount of cash, but we're definitely more fully invested than we have been historically. And look, we're going to continue to analyze the opportunity set, and we may put cash to work even if we don't see a big market sell-off, because our valuations may suggest that we think the markets look attractive and things are turning out better than we expected, and we can be more bullish. But right now, our equity portfolios are more heavily value biased, and we're definitely we're more cyclical. So cash gives us the opportunity to smooth the returns out a bit, but I would expect our portfolios to perform more like a sort of a more heavily invested portfolio than the cash weights would suggest. We're pretty optimistic about the medium term outlook and the medium term return potential, but volatility is going to happen, and so that cash we'll be quick to put that to work when opportunities present in the shorter term. But we're definitely positioned for we're owning investments that are pretty cyclical, and so having that cash is a bit of a buffer.
Thanks. We've got time for one more question here that has come through, and it refers to the bounce back earlier in the year. In hindsight, having sort of reflecting on the investment results and performance early on in the year, would you have expected the investment solutions to have perform better? Just summarising the long question here.
I think I would say we performed in line with how we were positioned, but I think when we look back now in hindsight, we were building positions in value in cheaper parts of the market that were more cyclical. So the market was pricing in the risk of a recession. It was kind of pricing in a more a central bank-led recession, and so we were starting to build some of the more sort of cyclical sectors up. In hindsight, we were more invested than we should have been, but we don't think we could have predicted COVID, and so we protected on the downside. We had cash, we were able to invest, but certainly if you ran the clock and said, well, it's an economic recession, how do you think you'll do? Then I would say that we would expected to do better, but I think we were positioned in the cheaper stuff, and I don't think anybody predicted COVID, so that kind of I think explains it. I think we've been buying things that are very cheap, and so as we've been buying in 2020, the things we've been buying haven't been going up; they've been going sideways or down. So we've been buying more, and that's what we expect with our approach. And whilst it'd be nice if things worked out exactly as we would like, we just have to take advantage of the opportunities when they're presented. And it just so happens that in this period, the opportunities have been presented in cyclical businesses, and our main focus is first and foremost, we're value investors. We're going to buy things for less than we think they're worth, and that's where the opportunities have been. But I think we'll continue to kind of refine our approach and reflect on what we can do better.
I see we actually time for one more question. Bit of a macro question comes through here. The difference in attitude towards China in the US, given Biden presidency, and then around sort of deteriorating Australia-Chinese relations. My lips are sticking together. What are your thoughts?
Sorry, I didn't catch that last. Sorry, I missed that. The audio broke.
Sorry, there's something popped through there. Again, I'm just summarising the question. Basically, the change in attitude as a result of the Biden presidency towards China, and then also the deteriorating Australia sort of Chinese relations in the last few weeks. Any reflections from your perspective and investment?
Yeah, I mean, I think so China's very unpopular in the United States right now, and so it's pretty consensus now. So whether you're a Democrat or whether you're a Republican, on balance, you're probably more negative on China than you were 4 years ago or 8 years ago. So, but I think the Biden administration will seek to ease some of that tension, but I don't think they'll do it straight away, at least in what I've been reading. And so I think it'll be a much more global trade friendly administration. So on balance, I would say we'll probably see an improvement in the relationship with China, and maybe even a pretty quick reversal to some of the more recent actions of the Trump administration, like CNOOC, the Chinese oil business was just put on the blacklist by Trump this week. So So there's a few moves like that that'll probably get reversed quickly. The tariffs, I think, will take a little bit more time to get reversed, but I would expect that the Biden administration will use those as bargaining chips to try to get some leverage. But I would expect it's going to be a better environment. I think Australia is going to take the lead of the US. I think the Trump administration has been very, very negative towards China, and I think Australia's followed along there. And I think if the Biden administration becomes more positive, I think you'll see the Australian government start to sort of become a little more positive towards China. But I think Australia has to face facts. I think they're our number one trade partner, and we are not the United States of America. And so I think we're likely to see more of that. And I think for businesses like metallurgical coal and iron ore, and certainly some of the primary agriculture, where we sell a lot of stuff to China, but they could also find an alternative supplier that could really damage our economy. And so I think what we need is more diplomats rather than let's say Trumpian style politicians.
Thanks, Daniel. Well, look, just a big thank you for your time, Daniel. I know it's pretty late there. I think it's 8 o'clock, if I do my maths correctly, coming up to 8.
That's right.
It's probably an early leave from work in Chicago. But have a lovely evening, and hopefully we look forward to seeing you safe and sound in Australia at some point. So take care and have a wonderful Christmas.
You're great. You too, James. And thanks for the invite, and thanks to everybody that joined us and for the great questions.